Let's begin by talking about the markets. It's been a good day for the markets today. The Nifty has managed to reclaim 23,900, which means it's gone up more than 500 points. In fact, it's the best intraday trade that we've seen in a span of 5 months. The Sensex too has gained about 1,900 points, and it's just a few points shy of the 2,000 mark, but it's broken past 79,000 again. So for the week, if you look at the Nifty, it has snapped that 2-week-long losing streak and registered its biggest single weekly gain in 8 weeks, closing around 23,900. Sectorally, the realty pack was the top gainer, and we've seen that pack hit its biggest single weekly gain in 6 months. In fact, most major sectors have closed in the green. In fact, the Bank Nifty has bounced well above its 200-day moving average at the end of this week. But it will be interesting to see how the markets react to the crucial assembly election results of Maharashtra, which of course will be declared tomorrow. And this is going to happen over the weekend, and whether or not we get some positive sentiment from the India-Australia test encounter after a spectacular showing on day one in Perth, all of that remains in play. So it's going to be an exciting weekend of results in politics and in cricket. But let's get a sense of where the markets are headed for us. Mayuresh Joshi is joining us on India Tonight. He's the head of equity at MarketSmith India. It's great always to have your perspective, Mayuresh, and thanks for making the time this Friday evening. Tell us about what you see in the markets, because yes, corporate Q2 earnings, they've disappointed the street. Consumption sectors are under pressure. You see a recovery in consumption trends, or is that weakness going to persist for a while, you think?
Evening, Vikram. As far as the consumption trends are concerned, I think it's going to be a slow and gradual process because urban consumption is well and truly slowed down. And there are a lot of data points to probably support that. Obviously, I think from a market's perspective, FMCG companies' commentaries are a testimony to urban consumption slowdown. But even household savings as a percentage of GDP has come down quite significantly over the past few months. And therefore, I think within the consumption baskets, rural expected to come back. Monsoons have been good. We are expecting a good Rabi harvest as well. And therefore, I think end of Q3, Q4, I think rural consumption should well and truly come back. Urban consumption, again, Vikram, I think in certain select pockets, it is still going very, very strong. However, I think for urban consumption to probably revive, you probably need to give it a quarter or two before urban consumption stabilizes and comes back again. So therefore, I think consumption trends, specifically in urban areas, seem soft, and therefore a lot of companies are exhibiting that through their earnings call.
Consumption story is going to be dependent on how our inflation scenario pans out. Retail inflation has come down, not much, of course, but it's just about moderated, but it's still above comfort levels. So how do you think investors should view the impact on sectors like FMCG now, the discretionary consumption? If you look at those particular sectors, what should be the approach?
So, Vikram, over a longer period of time, structurally, I think consumption as a theme remains for India because India is a growing market. And therefore, I think both consumer discretionary as well as consumer durables should see reasonable growth over the next 5 to 10 years. However, intermittent time periods will probably ensure that consumption trends like we are seeing right now might go through a patchy period. But I think I was reading through a few reports which are indicating that the discretionary spend per head should actually go 2 times or 3 times over the next 8 to 10 years. And therefore, a lot of sectors which will probably exhibit this enthusiasm, FMCG companies, jewelry stock, QSR players, should probably benefit over a longer period of time. However, at the current juncture, earnings probably seem to be soft, specifically for plays within FMCG and the jewelry stocks. However, with the wedding season, which is expected this time around, a lot of weddings expected, even jewelry stocks might make a comeback. So to that extent, again, a couple of quarters, it might still remain soft, but some recovery expected in the first half of the next financial year.
Mayuresh, this latest bulletin, the monthly bulletin of the RBI, is highlighting key concerns about moderation in growth and inflationary pressures. So how do you see the RBI doing that balancing act between growth and inflation concerns? How do you think they'll act in the next policy?
So, Vikram, if you remember the last time the governor spoke, he was very clear that maybe the October and the November print might be a little bit on the higher side, and it has come that way. Even this month's print is expected to be in northwards of 5%. And therefore, I think as the Kharif output starts coming in, as Rabi harvest has begun well and truly, I think whatever output that probably comes through, food inflation, both cereals as well as pulses, should remain largely under control as we head into the next few weeks. What you're probably going to see in terms of the durable inflation numbers, whether it's house rents, whether it's apparels, even those should start remaining stable. And therefore, I think inflation should probably come under control as we head into the next calendar year. And that should provide some element of respite as far as the central bank is concerned. The central bank will also like to see what is happening at a global level, what is happening in terms of US policy making, what is happening in terms of the bond yield movement when it comes to the US 10-year, the European 10-year. And therefore, I think global macros, geopolitics, as well as our own macros will probably ensure on how the trajectory will happen. At some point of time before we end this financial year, RBI will have a rate cut done. That is my opinion.
Like you mentioned, these global macros about US inflation, that seems like a mixed bag right now. The Fed is speaking about strength in the economy, the jobs market as well, is hinting at potential rate cuts next year. But what if the Fed deviates after the Trump inauguration? How is that going to influence Indian equities, particularly the export-oriented sectors?
So I think the markets will take that in its stride. But to a certain extent, a large part of the market expectation in terms of corporate tax cuts, as soon as Donald Trump assumes his presidency, is something that is expected. And if that probably happens, a lot of the discretionary spending in key sectors like BFSI, retail, manufacturing, they get that additional headroom with the tax savings that they probably got in terms of their IT budgets as well. And therefore, I think our players, specifically the IT sector, should benefit. What happens in terms of pharma specifically, I think that needs to be seen. But I think a lot of companies are working earnestly in terms of creating a very strong R&D pipeline in the specialty drugs. And therefore, I think as a lot of drugs go off patent, a lot of our sites which are FDA inspected have cleared their inspections as well. I think that should probably ensure that our pharma sector also probably survives the entire perspective in terms of both the FDA inspections as well as any tariff impositions that can probably come through. So again, I think selectively IT, pharma can continue to.
Meanwhile, the rupee, look at the way it's been moving. It has hit rock bottom, Mayuresh, and this, of course, against the US dollar. But how do you see it impacting sectors where we have high import dependency?
So to that extent, I think they'll need to manage their currency risk to a large extent. How they will do that in terms of managing their inventory, specifically players like tire makers as an example, because they are highly dependent in terms of crude derivatives. Similarly for paint companies, because everything that probably comes through will get mapped in terms of the rupee dollar exchange as well. And therefore, I think where the positioning of the rupee is at this juncture, a large part of the outflow has probably happened because of the massive FII, FPI selling that we've probably seen. And let it bring to your notice again, I think India is not the only market. I think it's a general emerging market pack that FIIs, FPIs have sold into. And therefore, I think with a record low, some export-oriented sectors benefit, import-oriented sectors, which probably depend on crude derivatives and the exchange rate as well, might find some element of inventory losses probably building up on their system. But I think the markets will take that in its stride. Personally, I don't believe that the rupee will depreciate significantly from the current levels.
Fair enough. But also a big question about the FIIs. They have been on this selling spree in Indian equities in the first half of November. Seems to be no different now with foreign investors pulling out more than $2.7 billion. And this is across sectors. There is some shift, though, because we've seen some buying by FIIs in the software and services and capital goods space. In fact, Mayuresh, just listening to my colleague, he's joining us right now. Sharad is here from our research team. He has the data. Sharad, do come in on this. How is it looking on FII outflows? They've been selling relentlessly, but how does it look for the first half of November at least?
Well, yes, we have seen the FI flows coming in for November 1st to November 15th, and for the first fortnight of November, here are the numbers. The FI outflows has been there to the tune of almost $2.7 billion, and if you look at the last 3 fortnights, there has been an outflow of $14 billion. Also, interestingly, only 6 sectors saw inflows coming in the first fortnight of November, and health sector has actually seen outflows in just once in the last 11 fortnights. So let's look at the headline numbers, especially in the key outflows part. Energy segment, the most outflows coming in at roughly $855 million, followed by financial services at $840 million. Also making it to the list are automobile, FMCG, telecom, where between 350 to almost $550 billion of outflows are reported. Now let's look at the inflows. Of course, the numbers are not very much, but software and services segment that has seen the highest inflow coming in at roughly $366 million, with minor inflows coming in between capital goods, healthcare, real estate, commercial, ranging between $25 to $108 million. Now let's look at how the weightage is coming in, the FI positioning in the sectors. Overall, the underweights is coming in the software, energy and the material segment. However, the overweight, if you look at it, that is financial services, that's roughly 2.7%, which has corrected minorly over the last numbers which we have seen in the end of October. But overall, FI flows, especially in the outflow segment, have been dominant across all the segments.
So that trend is not changing. Of course, we're talking about certain sectors. Mayuresh, Sharad, many thanks for painting that picture for us for the first half of November. So right now, Mayuresh, how do you look at FIIs and what they are doing as of now? Do you see this weakness? We're talking about the weakness in the Indian rupee. Could that exacerbate FII outflows in the short term at least? Or do you think that has been priced in already?
So I think a large part of the move has already happened, Vikram. Now there are no fresh triggers in terms of what probably can happen going forward, unless on a geopolitical front something goes wrong awfully. There might be mayhem, and that might happen across markets, across commodities, across asset classes. Having said that, again, I think because a large part of the move has actually happened, I think they are in a wait and watch mode as well. I think if you probably look at the construct within the emerging pack, the weightage for India probably is expected to improve over the next 2 years as well. From a macro perspective, again, I think a lot of experts would have pointed this out. India probably best placed. Micro perspective, earnings a little bit soft and patchy, but they should improve as we head into the first half of the next financial year. So whether you like it or not, these outflows are an adjustment in terms of what is happening globally at this juncture. But at some point of time, in an opinion, FIs will return back to the Indian markets. And if the markets move higher from this because of domestic liquidity, their entry points might be a little bit more painful for them.
So they might regret exiting it, perhaps that's what you're suggesting. But then if you factor in most of the moving pieces right now in the markets, which would be the fresh triggers, the biggest triggers for the next move in Indian equities, whether it's global, whether you look at Fed action or crude oil prices, or even domestic factors like GDP growth and earnings cycle, which would be the triggers that the markets are going to move to next?
So to a large extent, I think markets, Vikram, will move on earnings, and earnings will remain a little soft, as I said. But markets have a discounting factor over the next 12 months. So at some point of time, the markets will believe that as we head into the first half of the next financial year, earnings should start coming back in a normalized mode of around 12 to 13% as a base case scenario. And if that probably happens, and the Nifty happens to probably be in a consolidation phase over the next few weeks, my own sense is that selective sectors, selective leadership stocks within those sectors would gain interest as well. Our own take is that over the next few weeks, looking at how earnings have played out, domestic cyclicals remain the best bet. Select key BFSI stocks, select key housing finance stocks, select key agrochemical stocks, and a few of the infra and manufacturing companies have posted decent set of numbers, and they might continue posting reasonable set of numbers as well. So our opinion is focus on domestic cyclicals. Don't worry about sharp falls into the market. I think these sharp falls give opportunities for accumulating good quality stocks.
So buy on dips. And don't be too wary about any big corrections that happen in the markets. Mayuresh, that's always sage advice. Thank you very much for joining us with your perspective on the way the markets are moving currently. And we'll see how the domestic and global factors really play out. We'll keep circling back to you. Thanks so much.
Thank you, sir.
If you like this video, then like, share and subscribe to ET Now.